Drop it.
Hello and welcome to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, and joining me is...
Michael Becker of Sierra Pacific Mortgage.
Boy, you jumped right on that one this week.
Well, I've gotten used to you not using your adjectives now.
I may just, at some
surprise
point...
me. Keep me on my tippity.
Yes,
I'll be on my tippity-toppity toes.
Keep you guessing.
Keep you guessing.
Yeah, so Michael.
Yes, sir.
We're recording this.
Yes.
The day before a very special day.
Mother's Day.
So
I'm fortunate enough to have my mom still around.
I'm telling you, I wish we did. Both my mom and my wife's mom are gone.
Oh, both are passed?
Yeah, and it's been a while. But
sorry to hear that.
Man, yeah. But we're definitely celebrating my wife, who is a phenomenal mother.
There you go.
And
it's their day. You get to eat out.
Yeah.
It is. I'll be going to brunch with my mom,
my
mother-in-law, and Mindy and her children.
Beautiful.
And all the children aren't bringing their significant others, which is, it's fine when they do it, but this is for your. Mindy said she was excited because now she can actually talk to them.
Yeah. Well, that's going to be great. That'll be wonderful.
It'll be fun.
Yeah, and we're gonna have a small week because my daughter's out in Chicago.
Where are you going?
So La Cuchara.
Where's that?
Near Woodbury, that area.
Oh, okay, very nice.
Yeah, it's a really cool spot.
It's gonna have to be one of your spotlight places in the future.
It may very well be. Yeah,
we're going to the Point in Towson for brunch.
The Point's fun.
It's great. The food's good. They have a great brunch there.
Yeah.
Chicken and waffles are outstanding.
I can't do the waffles anymore.
I know you
it kills me. Yeah.
Well, they have. You could eat this. You just have to avoid the chicken. I mean, the English muffin. I often get the eggs Chesapeake, which is a crab cake, spinach, poached egg, and Old Bay hollandaise.
Ooh.
Yeah, it's really good.
That does sound good.
But
yeah.
Anyway, it's a tough day for restaurant workers. It's one of the top 3 days. Valentine's Day and New Year's Eve. These are big 3 holidays.
Point.
A lot of these guys out there are going to be working double. So I know you won't hear this by the time people hear it. But remember it for the next time you go out. Be kind to your servers. They might be working long days. It's incredibly busy.
Yeah,
the menu might be limited. They have no choice over the limited menu. The kitchen does that because the volume's going to be
because you're going to be
high.
slamming out so many meals. Yeah, absolutely.
Just have a glass of wine. If you're eating at dinner or if you're having brunch, have a Bloody Mary.
And just
or
chill.
And just chill and be glad and have conversation with the family.
Yeah.
That's why you're there, to get together.
Yeah, absolutely. Well,
that's my wisdom for this week.
Thank you, Michael. I love it. All right, well, this week we're talking about some pretty interesting things. Very common decision for every first-time home buyer makes this decision.
If you were to Google this, you could find 18 million YouTube videos on it, and everybody's got an opinion.
And they do.
Yeah. And we're going to give you ours, which will probably be the best.
Undoubtedly the best.
Rent versus buy.
We were better than the Wall Street Journal recently, so I think we're on a trend here.
Oh, because of the low level of price adjustments. Yeah, they messed that one up.
Yeah. But yes, the rent versus buy decision. So the episode we're going to talk about to buy or not to buy.
That is the question.
That is the question. That's the first time home buyer question, at least. But yes, absolutely. Should you buy? Should you keep renting? And there's a lot that goes into it, and probably more than most people think. So we'll have a good.
It's not as simple as what are the 2 payments. That's what we're going to.
Right. A lot more to break down. All right. But Michael.
Yes, sir.
Before we get into that,
we get some little.
We need to hear about your mortgage data.
Yep. We have mortgage application numbers for the week ending May 5th, 2023. The Mortgage Bankers Association comes out with that number. It lags a little bit. We are recording this the 13th, I believe, of May.
Yes.
So this was the week. But anyway, surprisingly, mortgage applications went up 6.3%. I say surprisingly not because they went up, but the amount they went up and what caused the overall increase. Mm-hmm. Purchase index was up 5%, which is to be expected. There seems to be a lot of demand despite rates. Rates did drop in the week of this survey, down to, according to the Mortgage Bankers Association, an average rate on a conventional loan of 6.48. It does seem that when rates drop, we do see a tick up in application. What surprised me and what drove the 6.3% increase in overall mortgage applications was a 10% increase in refinance applications.
All right.
I suspect two things are going on there. one, I've mentioned in the past, and the data does show it, that the VA does allow 100% cash out refinances.
Yeah.
So maybe there's some of that going on. And the other is that some people are sitting on a lot of equity, and despite perhaps the bad economic choice it is, they may have no other choice, meaning a lot of people's number one asset is their house. They may have not living behind their means, but have trouble keeping up with inflation.
Or anything could have happened.
And they've been forced to use credit
Emergency
cards.
situation, whatever. Yeah.
You've been forced to use credit cards to deal with that budget gap, meaning you're not bringing enough money to cover your expenses because of inflation or because of an unknown emergency or repair or something like that.
Right.
And once you break the seal on that credit card debt and you start running a balance,
Yeah.
the easier it is to let that thing get higher and higher. I've seen it happen where, before you know it, you have $20,000, $30,000, $40,000, $50,000 in credit card debt. As crazy as it may seem, we're sitting at all-time records, the Fed data states, on credit card debt. So I suspect maybe some of that refinance activity is not rate and term refinances where you're just shortening the term or the rate of the loan,
Right.
where you are actually cashing out the equity in your house. You're paying off your existing mortgage and some other debt. That rate that you take on that new mortgage is likely going to be higher than the rate you had already.
But it's lower than the credit card debt you're carrying.
And it probably results in a drastically lower monthly
payment.
outlay.
Yeah.
And the idea behind that is let's get these things under control, even though I'm taking a higher rate. If I get it under control and find a way to live within my means moving forward, perhaps there's an opportunity in a year or two down the road to refinance down to a low rate.
Yeah.
That's my speculation. As the Mortgage Bankers Association said, the rates for the survey week ending May 5th did drop to 6.48. Let me give you a little more update. This past week, we saw rates drop through most of the week until Friday. Wednesday was an all-important consumer price index. The numbers, both headline and core, came in right on the screws, but it was the internals. The internals, when it comes to core services inflation, showed some improvement, and that specifically is what the Fed is looking at.
Right.
Markets took that as a good sign, and bonds rallying, we saw a little improvement in rates. Thursday morning, we have the producer price index that came out, and that came out a little better than expected. And specifically, the year-over-year number was pretty good. Core was 3.2, overall was 3.5. That's much better than the consumer price index, and producer prices do tend to lead into consumer prices. So hopefully there's some improvement on the consumer price index in the future based on this. So bonds rallied even further on Thursday. Then all of a sudden, Friday comes around, and we get the consumer sentiment numbers from the University of Michigan survey.
Thanks, Michigan.
Well, but these aren't hard numbers. These are soft numbers. These are survey numbers, right?
Right.
And inside that, first of all, they thought the number for economic conditions actually plummeted much lower than expected, which is a bad sign for the economy moving forward. But what made bonds sell off was the inflation expectations inside that. And the 1-year and 5-year inflation expectations increased. And anything to do with inflation, it seems bond markets and rate markets are
so highly attuned to it.
They are so hypersensitive to that. We saw a bond sell off, and things got a little bit worse. Looking forward, I think that sell off was a little too much. It does seem that we're getting an improvement on the inflation front, and I expect the beginning the middle of next week to see some of those losses we had on Friday come back. I would have locked on Thursday, probably wouldn't have locked on Friday. I'd see what happens on Monday or Tuesday, and probably if I was somebody who had to lock a loan, would look to lock on any improvement. We are still range bound, Brad. It seems like we're stuck between about 6.3 and 6.75 on mortgage rates for about a month and a half.
Right.
And the bonds are kind of in that trading range that give us rates that way. So we're going to need either improvement on inflation or a real slowdown in employment. Thursday did have a jobless claim number came in higher. So if employment slows down, if hiring slows down, if unemployment goes up, we'll probably see improvement in rates. But we're going to need something major to break out of this range.
Yeah.
And I don't think it's going to happen in the next week.
So you're predicting flat.
Flat.
All right. Okay. Well, thank you, Michael. So rolling into the real estate side, looking at the Baltimore Metro stats, now we have the month data for the month of April. That's in. So we're going to be doing the month over month and the year over year comparison. So Months of supply right now, Baltimore Metro, 1.2 months of supply. And as we talked about before, months of supply, when it's considered a balanced market, that's about 6 months of supply, meaning the seller and the buyer, neither one of them have an advantage. 1.2 months of supply, pretty low, which means with supply and demand, the seller has a strong advantage. So, buyers, that's going to be your message. Pay attention to this, because the continued challenges in inventory and that months of supply number are going to drive a lot of what we're going to talk about. Okay, so let's talk about total sold dollar volume year over year, April 2023 versus April 2022. We're down 31.1% from last year. And in units, we're down 33.7%. The median sales price, this is kind of interesting. The median sales price was flat, $360 from year over year. Okay?
Mm-hmm.
But that's a little misleading, because we were up in most counties, and I'll tell you, I won't get to that in a little bit, but we were up in most counties except for one. And we'll get to that in a little bit. Median days in the market, it's up 16.7%. You know what that means? We went from 6 to 7. So
It's not a
from
significant thing.
one day, right? So when you see that, you might see the 16.7% number and think, oh, that's significant. No, it's really not significant.
You have to put numbers in perspective.
Yes. So that's why we have. All right. So anyway, new listings. Overall, Baltimore Metro down 41.3% year over year, April to April. Baltimore City was actually the leader, meaning that we had more new listings there. They were down less than other areas at 31.7%, and Harford County was the big loser in there, because the listings there were down 54.4%.
Wow.
Most everybody else was in the 40s. So Baltimore City, not down very much in comparison to the others, and Harford County significantly greater. So let's talk about Harford County, folks. You can sell your houses, folks. If you own houses in Harford County, we need you. Anyway, so new pendings, 24.9% down year over year. Baltimore County was the lowest at 14.9%. Harford County, again, was leading the pack with 33.9%. All right. Baltimore Metro sold listings, sales. Overall, 33.7% down year over year. Baltimore County, again, was the lowest decrease. We were only down 28.3%. And Carroll County, instead of Harford County, this time led the charge in the highest loss in sold listings, down 41.3%. All right. Median sold price, as I mentioned, for Baltimore Metro, $360 flat year over year, right?
Mm-hmm.
Harford County up 3%. Baltimore County up 7.7%. Carroll County up 9.4%. Anne Arundel up 2.4%. Howard County up 9.4%. Baltimore City is the only one that went down, 5.8%. But I guess because of volume, that 5.8% carried the day and kept things flat overall. Median days on the market, the Baltimore Metro, again, we were up 16.7%, right, from 6 to 7 days. Most counties went up a day, basically a day. Baltimore City, however, they were up 66.7% year over year, from 9 days to 15 days. Now, still, 15 days is still pretty rapid. So we're not looking at very long lagging times on the market, but it's numbers to track. And then that average sales price to original list price ratio that we talk about on a regular basis. Year over year, we're down overall in every category. Baltimore Metro down 1.8% year over year. The lowest was Baltimore City, 97.76% of the sold price to original list price. And Howard County had the highest at 102.34. So in every area other than Baltimore City, people were paying above list price. I wanted to bring in some other data from Bright MLS that talks about showings. And
okay.
It's,
I'm interested.
So
in
you because it's actually kind of a leading indicator for us, kind of like mortgage applications.
Sure.
And you mentioned mortgage applications were up.
Mm-hmm.
Oh, so compared week over week, we were up 7% in showings. Now, compared to a year ago, showings are down 8.9%. But that was, height of still in the throes of.
Rates were rising this time last year, but they were significantly better than they are right now. And
Right.
people were probably rushing to buy who had
As
waited.
those rates were, right.
A lot of times when rates rise, people jump off the fence and decide to get in.
To get off the fence, right? So we're down 8.9% from last year. But if you look at the comparison between 2023 and 2019, which was the last more normal market before COVID hit, we've been trending above the 2019 levels in showings all year except for 1 week. Except for 1 week, we've been above the 2019 levels. And I just thought that was relevant information, some important information to share because to your point, Michael, about the application data going up, it just gives you the idea of how much activity is still going on, how much demand there is, and why their months of supply and the demand that exists becomes such an issue. So buyers, here's the takeaway, when you're thinking about putting in an offer, it's probably going to have to be a property that you might find attractive. A lot of other people are probably going to find attractive. So be prepared to come in strong on that offer. This is not the market to look for the deal. Unless you go after properties that have been sitting for 30, 60, 90 days on the market. And even then, sometimes you still can't get a great deal.
Right.
I was just looking in Lutherville, 21093, and when you look at properties that have been on the market for in excess of 30 days, the properties that sold are still selling at like 94% of the original list price. And it doesn't until you get to 5 months on the market, 150 days ballpark, it doesn't change. It doesn't get above 10% reduction. So the point is, this is not the market to look for that bargain. Even when the property's been sitting on the market for a long time, they're still selling relatively close to list. So you just have to realize you're going to have to come in aggressively if you make an offer. And sellers, it's your advantage. And the best time to sell is when competition is low. So if you've been thinking about selling, we've been very successful recently in getting buyers under contract, even in this very competitive market. So if you have a property that you are thinking about selling, it's a good time to have that conversation to see what's possible.
Yeah, absolutely.
All right. Well, Michael.
Yes, sir.
Thank you for your information. Great as always.
Thanks for your input as well. I mean, everybody's predicted the real estate collapse and values dropping, and the demand is still way exceeding supply.
Yep.
And your data just shows that.
Yeah, absolutely.
As do the mortgage applications.
Yeah, absolutely. All right. So, Michael, when we come back, we're going to get into the scoop to buy or not to buy. That is the first-time home buyer question. So we'll be back in just a sec.
Try it.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, sitting next to my bud.
Yeah, we are friends. Lifelong friends. Michael Becker of Sierra Pacific Mortgage.
Hey, Michael.
How are you doing, Brad?
Ferd. Dude.
Brad Bradford.
It is Bradford, although
Bradford
there's
Cox.
only one person who ever really called me Bradford, and then it was always Bradford Allen. That
So
was
that sounds
my
like a
mom,
mother.
and
Yeah,
and to bring back the whole Mother's Day thing.
yeah.
Yeah, that was when I was in trouble, which was all the time.
Oh, all the
I
time.
heard-
You always use your first two names. And
Yes.
for me, since this is Mother's Day and a tribute to Mother, you knew you were in real trouble, or your mother was incredibly frustrated if she went through all four of you and your brother's
siblings
names,
before
because she
she
couldn't
got-
figure out who
Right.
was used. She was so mad.
So frustrated.
She'd be screaming at me. David, Mark, Stephen, Michael.
Yes, exactly. Hey, dude, we even got the dogs' names thrown in. So
Wow.
before.
My dog was sweet. She never did anything.
No,
bad,
but she would. Oh, yeah, it was funny.
Yeah, she would do that. She'd go through the litany of names when she was angry.
Yeah, well, moms, love you, mom. Miss you, mom.
Absolutely. Absolutely.
All right, Michael. Well,
Yes, sir. This is a very important show.
Yeah.
And we're going to try and go over all this data well. And the reason it's important, so prior to doing a podcast, we used to do a radio show.
Yeah.
And part of the intro it mentioned that this was likely most people's largest financial decision.
Yeah,
It often
absolutely.
is, buying a home.
Absolutely.
We don't take it lightly. So it's something you need to weigh the pros and cons of everything and think about it legitimately. There are economic or financial reasons to buy, but outside of that, there's also emotional or lifestyle reasons
Absolutely.
to buy a home. And we're going to try and go over everything and give an even, because look, not everybody's meant to buy or own a home. There's lots of benefits, and we're going to go over
There
the pros
can be.
and cons. But
Yep. I think there are far fewer benefits to renting than there are to buying.
well, it has to suit your situation.
But yeah, absolutely, and it can very well suit someone's situation.
And the truth of the matter is that home ownership is in the high 60s, I think.
Yeah.
If it gets much higher than that, they tried to expand it, with the Community Reinvestment Act, and then some of these subprime lendings came in to increase home ownership, and it was an unmitigated disaster. Because some people just are not meant. To loosening the guidelines to allow more people to own homes may not be the right decision.
Yeah, yeah.
So you do definitely have to be financially prepared to buy a home. But why don't we just go over?
Yeah, and to your point, I think the financial aspect of it, yes, being financially prepared is super important. And I think people used to say the thinking used to go, well, renting's throwing money away.
Throwing money away, or it's a waste of money, or you're paying your landlord's rent.
Right.
I mean, there's mortgage
and
payment.
Buying is just instant investment, and yeah, that may be true, right? If you think about it just from the financial perspective, are you going to benefit over the long run by owning a home versus renting? Yeah, we do believe that. We wouldn't be in this industry if we didn't believe in the value of home ownership.
The stats bear that out. The net worth
Is
absolutely 40 times greater.
40 times greater. Yes, absolutely.
But
that
owning a home's not
reality
for
of
everybody.
that the decision it's a much more nuanced decision. Yeah, absolutely.
Well, and it makes even more sense now to talk about it, especially the financial aspects of it, given where we are and how crazy the real estate market is. We've seen values go up, and now we're in a time where interest rates are a lot higher. So the expense of owning a home on a monthly basis has gone up, but it still probably makes sense for a lot of people. So let's just kind of go through things and think about everything is there. I think a great way to start is just to go over a list of pros and cons.
That's a great idea.
And then we'll give some examples as to what we're talking about.
I like that.
When it comes to that. So pros, let's start with buying a home. Because most people, like you said, if you rent is throwing money away.
Yep.
It's not really. You got to live somewhere, someplace, somehow.
Housing's a real cost, regardless.
No matter where you do it. But there's that saying, and there's the, if you're renting, you're paying the landlord's mortgage payment. That's one of the big things. So a lot of people most people would probably say buying is more important. And let's also state at this point, the calculation from a financial standpoint isn't as easy as comparing rents to mortgage payments.
Sure.
There was a very short period in the last decade after the housing crisis when rates were really low. I'd say 2012, the Fed helped lower interest rates to stimulate the economy.
Yep.
And we saw property values drop a lot. And yet a lot of people were cautious. In hindsight, it was a great idea to buy in 2012.
Oh, yeah.
And I remember doing some of those radio shows I said where I would compare rentals prices of single-family homes or townhomes to the mortgage payment, and they were very similar.
Yeah.
Almost always, through time, the mortgage payment is probably going to be a little bit greater
Sure.
than the rent payment.
Yeah.
But that mortgage payment includes a principal pay down, and that shouldn't be in that monthly cost because that's almost like putting money in a bank because it's paying
It's an
the loan
asset.
down.
Right. Absolutely.
So it's a lot more nuanced than comparing rents versus mortgage payments.
Yeah.
Let's start off by saying that.
Yeah,
All
good.
right, and we'll get back to that.
I like that.
All right, you want to go? Why don't you go down the list of the buying pros?
Well,
Since you sell houses
I
and
do.
help people buy houses for a living.
Yeah, and I think that's the better way of saying it. I help people buy. I don't sell. In fact, the house pretty much sells itself. The selling side, when I'm working with a buyer, I don't sell them on anything.
Yep.
They're either convinced that they want to buy or they're
Oh,
not.
no.
So, but anyway, all right. Probably the first one is you actually own the house, right?
Right.
If you're paying rent, you're not building any equity.
That equity is a big thing.
Yeah, absolutely. So when you pay that mortgage, as you mentioned, Michael, it's part of that debt services that paying off of the principal for the mortgage. That goes toward building an asset, a nest egg for you. It's kind of like a forced savings account.
Exactly the words I was about to say. I always call buying a home a forced savings plan because it's an illiquid asset, meaning you have to sell it or refinance to get any of the equity, and not 100% of the equity is tappable at any given time.
Right.
But slowly over time, paying down to the principal and the value of the house going up, you build equity. It's almost, and if you ever look at a chart, the equity grows as the payment goes down. If this was a visual medium, it would be much more. But anyway, it makes sense, right, folks?
Yeah.
If you pay the mortgage down, the equity of the house goes up, and as the value increases, so you have those both working at the same time.
And I think it works better in the housing arena than it does in I'm never a fan of like having your withholdings too high on your taxes as a forced savings. I don't love that.
Kind of thing. You mean
I don't
people,
love that.
People who like refunds at the end of the year and they'd be better off not
Investing
giving the
that
government
money,
an interest-free loan
Yeah.
and putting the money away.
Yeah.
Absolutely.
It's completely different ballgame in the housing arena. Anyway,
Number two.
You can cash in on that appreciation, right? Your home's going to almost certainly, historically, always has increase in value over time, and depending on if you put money into it, if you maintain the home going forward. But say you bought a home that, we were talking about, what were we talking about? We were talking about my parents who bought their home in Perry Hall.
These are extreme examples.
Yeah, but they paid. In 1983, they paid $65,000, and then it was sold in 2012, maybe, for $270,000. The house values go up over time. And
Generally
that was
speaking, there was a
before-
rare instance in the aughts.
Yeah,
The teens, I guess.
the early teens.
The early teens where property values declined somewhat. It was because of the financial crisis and the subprime bubble bursting. The federal government tried to support the housing market by offering tax credits to people who were first-time home buyers.
Yeah.
They were in ways of refunds or rebates. When they stopped that, property values started their decline up again and continued to about 2011. They stopped, but it's been we've recovered all those losses and then some from them. And that was the first time post World War II that housing values had ever dropped.
Right.
Looking forward, nobody has a crystal ball. I don't see it happening given the demographics of the United States over the next 10 years. Beyond that, time will tell.
Yeah.
Maybe we'll see a flat period. If builders get over exuberant and build way too many homes, maybe that would happen. But all we have is the past.
Yep.
And over time, houses do appreciate. And
I can tell you, I wish I would have held on to that property as a rental
There you
and
go.
let it appreciate over the next several years rather than selling it in 2012. But that's
Can we give you an extreme example
sure.
of house appreciation?
Yeah, let's hear it.
As a child, we used to go to Stone Harbor, New Jersey, and my grandfather, we rented there for a while, then he decided to buy a house, bought a lot and built a house, a 5-bedroom, upside-down house. What that means is most of the bedrooms are in the bottom floor, the living room, kitchen, and dining room were upstairs with the master suite.
Okay.
He bought it, and as he was getting older in the early to mid 80s, he decided that he didn't want to maintain it anymore. His grandchildren didn't find it interesting anymore. They wanted to go to Ocean City, Maryland, where all their teenage and early
friends
20
were.
friends were. Right. So he sold it. I'm not sure what he sold it for, but I think it was in the $300,000 or $400,000 range, which is a lot in the early 80s.
Yeah, sure.
That house is worth $3.4 million right now. Imagine if we kept it as a family.
Wouldn't that have been remarkable?
So that's an extreme. The idea is you do get the cash on. Now, usually what we mean by cashing on an appreciation, when you buy your first house, you pay down the mortgage and it appreciates. When you sell it, you get a lump of sum. That sum isn't spendable money. Generally, you put it into the next house, which is larger.
Right.
But over time, let's say you buy 5 houses over life and you move up, the first 3 or 4 are moving up in value.
Yep.
As you become an empty nester and it's time to downsize, more times than not, you have enough equity in that final home to pay cash and maybe even have some spending cash to walk away with.
Yeah.
If you rent it over that entire period, you've got the
zero.
20 to 40 year period, you've got nothing.
Bupkis.
All right.
Yeah.
Next one.
All right, you got some potential tax advantages.
Let me talk about one that's real important, that it's not what you're probably thinking about, and it's what I just said about the appreciation.
Yep.
Owner-occupied property, if you've owned it for 2 years and lived in it for 2 out of the last 5 years, a single person does not have to pay capital gains on the first $250,000 of appreciation.
Yeah.
If you're married filing jointly, it's $500,000
Right.
tax-free earnings.
Right.
If you buy a stock, you can't
You
live
can't.
in it,
No.
and you're gonna, unless it's in a retirement account. But even then, or a Roth, and you
If
buy
it goes up
Yep.
and you sell,
you're going to have to pay a capital
gains,
tax.
right?
But beyond that, we're talking about the ability to write off mortgage interest and property taxes. This helps a lot of people, especially where rates are now, itemize their deductions. When you do your taxes, you have a choice of either taking the standard deduction or itemizing deductions. If your itemized deductions are greater than the standard deduction, it makes sense to itemize. In this day and age, sometimes it might make sense to itemize even if it's just a little bit below the standard deduction, because we live in Maryland, a high tax state,
Right.
and they didn't increase the standard deduction. Like,
No, they didn't.
please contact your tax advisor for what I just said, but it is true.
Yeah.
Anyway, there are potentials. It's a lot easier for a single person to take advantage of itemizing deductions.
Yeah.
Because I'm trying to I think it's $12,900 is the standard deduction. It's like $25,800 or something like that. It may be up for 2023. That might be 2022 numbers, but it gives you an idea.
Yeah. Yeah.
This day and age, if you buy a $400,000 house and you have a $350,000 mortgage, you could be looking at, I'm doing this in my head real fast, Brad, so forgive me. You're looking at $24,000 in mortgage interest. Right there, you're getting close to being above it.
Right.
You add in your property taxes and any state income taxes withheld with a $10,000 cap, you're above it.
Right.
And in charitable deductions, blah, 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 all of a sudden you're itemizing and there is a tax benefit.
advantage.
It's not as great as it used to be because of the increase in the standard deduction,
Right.
but it is there for many people.
Yeah, absolutely.
Did I talk
And
too much about that?
No, but as Michael mentioned, always talk to your tax professional to get real information on any tax implications of buying or selling the home.
All right, this is a good one that a lot of people don't think about. The next one, Brad. Why don't you read it?
So you can make the home your own. You can renovate it. You can update it. You can paint the walls any color you want.
You want to paint it hot pink from top to bottom. Nobody's stopping you.
Right. You want a little extra space, you can put an addition on it. If you want a man cave, great. Put it in. If you want a new luxury bathroom, knock yourself out. You want to put in your wine cellar, Michael?
I'm there.
Have at it.
Hey,
you can't do that in a rental.
And when you rent a house and you want to make it your own, I'm not saying upgrade it or do things to it, but as simple as hanging shelves or paintings.
Yeah.
When you move out, if you don't fix them, that's going to be the cost of those repairs is going to be deducted from your security
Anything
deposit.
other than normal wear and tear,
Right.
that comes out of your security deposit. Yeah,
So
absolutely.
you're going to pay for that anyway.
Yeah.
I love this last one. Nobody ever thinks about that, but if you've been a renter, you've dealt with this, right?
Yeah, dude, absolutely. And you might still hear about it. You might still deal with it if you're in a condo or sometimes townhouses.
But you have somebody to complain to.
You do.
The condo association.
Right.
You know, you could bring it up at meetings. Anyway,
you got more privacy.
There you go, bro.
Yeah. And there's an article we were looking at that has a great.
I love it.
It has a great example here. Ricky and Lucy are arguing again. And because the apartment drywall is as thin as a playing card.
It often is.
Right. Every tenant can hear them. Having your own house means no Ricky, no Lucy. Anyway.
And flimsy apartment walls to deal with, just you, peace and quiet.
Yes.
Unless, of course, you're watching a marathon of the Great British Baking Show. That was a great line.
It's a great line. It is a great line.
Yeah. But yes, it's not only the thin walls. An apartment complex, 3 levels off and maybe 4.
Yep.
How about you're in the middle level?
Yeah,
Or
you get it from all angles.
If the people living above you have little children.
Mm-hmm. Yep.
Can you hear that on the microphone?
Yep.
So
absolutely.
That is definitely a pro of buying it, especially if it's a single family. Townhomes, you can occasionally you might have a neighbor entertaining on their deck and you might be able to hear it, but it's not nearly as bad.
Not as bad.
And if you get good sliders, good windows, you can usually find a place. And if they're neighbors and you get along,
maybe you're there anyway.
You should be over there enjoying anyway.
Yeah, that's right.
Exactly right.
Yeah.
All right. So those are some of the pros to buying a house. How about some cons?
Right. So, okay. If you want to relocate or travel, it's maybe a little more difficult to do that, right? If you want to go to...
We have to have somebody to maintain the house, to make sure the mail's coming in.
Yeah, like the whole nomad, hey, let me go rent let me go get a Mercedes Sprinter van kind of thing or whatever and outfit that and go spend a year and a half living on the road. And, well, if you own a house, it's a little tougher to do that.
Well, and I think the travel part is a point to be made, but the relocation, if you're somebody, the relocating is a very valid point. A lot of people have jobs that make them, they move from town to town or from place to place. If
it's quicker, if it's more rapid.
If you're somebody who's not ready to put down roots, if you maybe part of your career path is somebody who might jump around a little bit in order to gain experience.
Really common in the software industry. Right. You'd spend 2 years in one place, 2 years in the next place, 2 in the next, and you get a nice bump up every time you move to the next job. So
buying a home in that instance probably wouldn't make sense. It probably makes more sense to rent a house.
Yeah, you need to. I think if you're thinking about buying, you need to be ready to commit to a location for. I'm going to say the number's getting higher, especially with rates being where they are and expenses being where they are. We used to say 3 to 5 years. I'm going to say it's 5 to 10. 10 being probably the ideal.
I would agree with that because of the higher interest rates, but the unknown in that equation is the amount of appreciation. I have clients who bought in early 2020 who have so much equity that they're able to sell and buy they did 100% financing at the time.
Right, but they've seen so much appreciation.
Bought something for $450, went to $600,000.
Same thing happened to this guy that he works for Amazon, and he bought up in Aberdeen, fully expecting to live in Aberdeen for 5-10 years or whatever, and it was new construction. And we always worry about losing money on new construction when you just first start out, but he bought and had to sell a year and a half later. But because of the appreciation that went on,
COVID changed things.
It really did. It really did. Now we're not going to see that level
moving forward. So based on what we project as appreciation over the next year, and if you were to extrapolate that out over the next 5 years, and if you buy and never refinance, you probably should stay put a little bit longer. The 3 to 5 years might go to 5 to 7 years. Staying put, and then you'll be okay. The longer you stay in the home, the more financial reward you'll reap.
Yep.
You'll have the opportunity to see more appreciation and pay the loan balance down further, so it'll be easier to walk away with some proceeds from selling of that house.
Yeah.
Now,
And if you're to get back to the whole travel or relocation thing, if you get into that situation and you've bought and you get relocated,
what do you have to do?
you got to become that reluctant landlord at that point.
Not
right?
a bad idea. And there's property managers who can help you out if you're on the road and you're away from your property.
Yeah. So there are ways to deal with it.
You may not be able to recoup all your costs per month costs,
But you've got some revenue coming in.
got some revenue can offset it. You might be out of pocket a few $100s a month, but rents are pretty high, and you should be able to recoup a good part of your monthly expenses if that were to happen.
Yeah.
And that's it. That's unexpected, meaning if you bought a house, had plans to stay, and had to move, then maybe you would become that reluctant landlord and rent it out.
Right.
All right.
Okay.
More expenses is the next
Yeah,
con.
so you got more expenses.
Now,
Right?
there's monthly expenses. One thing they don't list here, and we should talk about, are the ongoing expenses of home ownership. But go through the monthly expenses. Why don't we talk about them first?
Yeah. So there's your mortgage payment,
Which
That
includes
mortgage
your
payment
insurance.
includes your property taxes, your insurance, and your principal.
Right.
And then there's ongoing maintenance.
Right.
And then with regard to homeowners associations, you might have additional expenses there.
You have one thing to pay when you pay rent, and that is your rent. When you buy a house, you have
And renter's insurance.
And renter's insurance.
Yeah.
Correct. Two things. Thank you. But renter's insurance is quite
It's
often
so tiny.
much lower than the homeowners. When you buy a home, you have a mortgage payment, which includes the principal and interest portion of your monthly payment, but you also have the homeowner's insurance is included in your monthly payment for most people, as are property taxes. And if there's flood insurance, that's included as well. HOAs or homeowners association fees are paid outside of that. Right. Those monthly expenses, as we said earlier, are probably greater than the rental and the renter's insurance monthly expenses. But beyond that, another con is what you said, the ongoing expenses.
Yeah.
What's a good number? We've talked about this in the past that you like,
We
that
like
I
this
like.
number, absolutely. Yeah, you should be prepared
For
to
ongoing
invest
expenses.
for ongoing expenses, ongoing maintenance in the home, about 1% of the purchase price of the home annually. Now
you don't have to spend that every single year, but
you're not going to.
Socking it away is not a bad idea.
Because you're going to have to replace the roof at some point. You're going to have to replace the HVAC, water heater, things like that. And yeah, you might have 1 year where all you're doing is fixing a leaky faucet, but over time you're going to have some of those more expensive repairs that you're going to have to make. Yeah, absolutely.
Oh man, I just reading the next one.
Yes.
Just made me think of something. But
okay, so the next one, you're the landlord.
Correct. If the
You gotta
roof
take
is
care of
leaking,
everything. Yeah.
You talked about it. Guess what? If you're a new homeowner and the roof's leaking, well, if you work with Brad, you probably would have had an extensive home inspection done when you were buying the home.
Undoubtedly.
You would have determined that the useful life of the roof is 5 to 6 years. You're going to need to replace down the road.
Yep.
So if that's the case and you have a leaky roof, you probably look at patching it.
Yeah.
Initially, that's a much lower expense. But if
Right.
you have a leaky roof, you do have to. If you own a home, you have to fix all repairs, even down to little things. How about a toilet?
Yeah.
That I have my beach house.
Yeah.
I have, being a dad, dads do this. They hear everything. I said to Mindy, I said, you don't hear that? She goes, what?
Right.
I said,
The
the
water's
toilet running.
running. Yeah.
I said, and it's every 5 minutes, all of a sudden I hear the toilet run for a few seconds.
Yeah.
What does
Flapper.
that mean? Flaky flapper valve.
Yes.
Dads know that, right?
Yep.
That's how much do they cost? $6 to $8?
Not a ton.
Pretty easy thing to fix.
Yeah.
But if you're not attuned to that, what's your water bill going to be if you have that
Oh my
leak?
gosh,
And in
yeah.
Baltimore County, the sewer service
The
and water
sewer service,
distribution
right. Yeah.
bills are based upon your water usage. So
Yeah.
you
It
get
can
hit
really get
double.
you can get socked for that.
doubly. Anyway, you need to fix those things and be prepared to fix. And owning a home actually is a good way to become handy, because you learn
Absolutely.
to not sub every one of those minor expenses.
YouTube is your friend.
YouTube is your friend. There's a video on replacing anything.
How to do anything. Yeah. Now, there are certain things I still won't do, right? Like, I'll go and replace a switch or maybe
ceiling
like
fan or a light or something
and
like
I put
that.
in a new faucet in
But I'm
our
not
kitchen.
wiring to a new light and an outlet.
And 220, nope, don't touch 220. I don't do that.
I'm not
And
going
I
to
don't
replace
mess
a
with
whole
my-
toilet. I probably might be able to replace a whole toilet with a wax seal, but
You could do that.
I
do
might let a plumber do it. But I had a cracked tank
Yeah,
in a toilet, and I replaced that piece of cake.
sure.
Took off like 20 minutes.
Yeah.
So-
Yeah. There are certain things,
So
like I
there's-
said, there are certain things
you tend
I
to
won't do,
become
but
a little more handy
You
if you're
do.
in a home.
Absolutely.
All right, and the last thing about a con.
Yeah, you got to save up some money because you got to come up with some expenses when you do the purchase, your down payment and your closing costs.
So down payments, smallest ones are 0% with USDA and VAs, but it's probably that's a very small percentage of the mortgages out there.
Yeah.
Conventional loans allow 3%, FHA 3.5%, and then closing costs, because you're not going to, in this market, you're typically not going to get any closing cost help from the seller.
Right.
So you might be looking at 4% of the sales price of that, so 7.5%, and you may even have to save a little bit more if you have to put in an offer that's a little over list or cover a small appraisal gap. That's very common in this market because things are so tight.
It's a great point, Michael.
But that money that you put into the house, you don't have to do that when you go to rent out property or rent an apartment. First and last month's rent, maybe, so 2 months of rent,
Right.
Maybe 3 months worse if you have to add a security deposit.
Well, there was a good rundown in this Forbes article that we saw that had some expense.
Tell me about that.
Well, so I liked everything about the Forbes article because it was a very good, informative article. We'll put a link in the comments to resources for the episode. But this Forbes article did a great job breaking down some pros and cons as well. But then they got to this chart, and I think they screwed up a little bit.
Well, I'm fixing it right now as we speak.
I don't love their chart. But anyway, so they talk about the buy side. If your first year costs, your down payment, the first thing they talk about is the myth. You got to come up with 20%.
Yeah.
Well, that's not always the case.
So I would say this is how you fix that. Take that $60,000.
Yeah.
And make it 5%. So that seems fair. You could even go a little bit lower.
5% is reasonable.
So that's a 15% down payment. So just drop
It saves you $45,000.
So the bottom line there on that Forbes article is $44,636.
Yeah.
Right. So anyway, the first.
Yeah. But anyway, but now your monthly payment will go up because you're financing a higher number, but not that much. Mm-hmm. So anyway, but they have the closing cost to buy about 4% of the price, and then you've got your monthly payment stuff and all that kind of stuff. But then they go into the rent costs too, and there's some issues with this because they ignore on the rent side. Yeah, they talk about your rent payment, and it's $2,400 a month. Well, that's all they factor in for your costs to move into that property. Well, that's not true. You've got a security deposit that could be $2,400 to $4,800. Maryland maximum is 2 months of rent for a security deposit, but so anywhere from $2,400 to $4,800 in security deposit, and then you've got you might have some move-in costs because certain condos, things like that, have a move-in fee that gets passed along to you. So you have to factor in all that stuff. So their monthly costs on the rent were too low, and their monthly costs on the
first year costs are going to be a little closer. It's still going to lean towards. It's going to be lower first year costs.
It's still much lower in the first year to be a renter.
These are just out-of-pocket costs. They don't factor in any kind of appreciation.
Absolutely.
Or tax.
Absolutely. And then if you get into year two, once you've gotten past all those sunk costs of the down payment and all that kind of stuff, then you get into what's your monthly payment? What are you dealing with? And then you start to get closer. And then it doesn't factor in year 2, year 3, year 4, year 5 when rents start to increase. But your mortgage payment stays the same. Well,
that's the point of the show. We're going to kind of go through all those and talk about it. But it definitely is a con for buying a house, the out-of-pocket expense. If you're somebody who only has $5,000 in savings, you may have to rent for the next year and try to increase that savings.
But don't think that you have to come up with that 20% either. I think people often delay their purchase because they think they have to come up with that 20%.
According
National
to-
Association of Realtors.
Oh, I have that. I was about to quote a number. Let's see if it's the same as mine from the National Association of Realtors.
National Association of Realtors puts out what they call their Generational Trends Report every year. The 2023 Generational Trends Report, for all buyers, the median percent down payment was 14%. Oh. But in that first time, because we're talking about the first time home buyer rent versus buy decision, that first time home buyer age group,
yes,
which I would characterize goes all the way up in this chart to maybe age 57, but because they're fairly similar. The median percent down payment from 24 to 57 is right around 10%. 8% for when you're 24 to 32. You go 33 to 42, it goes up to 11%. 43 to 57 was 10%. So right around that 10% mark. That's not 20%. Doesn't become 20% until you get up to 58. 58 to 67 puts down 20%. 68 to 76 puts down 21%. 77 to 97 puts down 27%. And those are those people who have owned before and they have money to roll in to the down payment and put it because they've had appreciation in their previous home, like you mentioned before. So yeah, don't delay that purchase thinking that you have to get to a 20% down payment.
So I was going to be so expansive on my number quoting there.
Well, you know
me. That's quite all right. Yes, a con of owning a home is that you're going to have to come out of pocket with more money. You're 100% correct, Brad. 20% is not needed. In fact, the stat I was going to bring up was from a survey of the National Association of Realtors where they asked people, first-time home buyers, and it still astounds me that 45% answered that 20% down payment was possible. Yeah. That number only comes from the mortgage insurance factor that people think about.
You don't need, or MIP.
Yes, you do not need 20% down, but it definitely is a con. You're going to need more to buy a house. Is a financial decision. It's a very big financial decision, and it does take a little bit of a financial commitment on your part. Yeah. But it's not going to be the $99,000 in first-year costs that Forbes put in their magazine.
Yeah.
It's more likely the entire cost. That's mortgage payments for a year, and everything associated with buying the house is probably going to be more like $40,000 than $99,000, somewhere in that range.
Yeah.
Okay, so those are the cons. Let's talk about renting a house, because if you don't buy a house,
you might need to rent.
Unless you're going to live with mom and dad.
Yeah.
Or or live on the streets.
Yeah. You're going to rent.
Or be a beach bum somewhere, which doesn't sound bad to me sometimes.
Yeah. Live in San Diego.
You're going to rent.
Yeah.
Right. If I was going to,
PB, that's the place to be. That's what I always used to call it. Pacific Beach in San Diego.
We already kind of mentioned this about, when it comes to buying a house, how you can't vacation or relocate a lot.
Yeah. When you're renting, you can move pretty easily.
Tired of the city you live in? Finish up your lease, or even ask your landlord if you can get out of it.
Yep.
Sometimes you can pay a 1-month penalty and
get out of your lease. Or sublet and get out.
Yep, or sublet and get out. When you rent, you don't have to stay in a location. It's pretty much to get out of it's a lot easier to get out of a lease than a mortgage.
Right. Absolutely. Absolutely.
You talk about assumable mortgages, but there's not many that are assumable, and plus you got to go through all this stuff. You're right. It's a lot easier to get out of a lease.
Absolutely. The other one that we talked about just on the other
a lot of this is going to be going over.
You're not your own landlord. You're not your own landlord. You don't have to pay for that maintenance. You report that leak in the faucet to your landlord. You report the
leaky
issues.
Toilet, the toilet that's backed up, the leaky roof or leaky ceiling, or the stove's not working. However, who's going to fix a problem faster, your landlord
or you?
Or you.
Right.
You're probably going to fix it. Although I'm pretty responsive to my tenants. When they say something, I'll get it as soon as I can possibly get it.
Yeah.
Especially if your landlord's decent and you've been a good tenant, the likelihood of you responding to repairs quicker.
Yeah.
If you're behind on your rent, they might drag their feet a little bit.
Right. But you're not taking off time from work, arranging time to meet the plumber, to whatever, deal with a roofer. You're not dealing with all that. That's the landlord, so you don't have to worry about that.
So that's definitely a pro.
That's a big perk.
Easy to move, no maintenance, and then the last one, we just went over numbers in the short term, and this is what's important. It's what?
It's cheaper.
Cheaper to rent than to buy in the short term.
Right.
You have virtually no maintenance costs. Renter's insurance is low. Moving costs will also be lower. Moving costs, I'm assuming they're talking about like moving costs and including closing costs for buying a house with a mortgage in their moving costs. So there's that is definitely a pro. It does allow. I think flexibility basically is the key to that when it comes to renting a home. A lot of young people. I don't think many people go from living. There are a few, but not many go from living with their parents to being homeowners. So renting an apartment for a little bit.
We rented for a year and a half.
Get you used to making a monthly payment, living on your own, being adulting as we call it.
Exactly.
It's not a bad thing, but so in the short term, renting is not necessarily a bad thing. But being a renter for your whole life, as we've shown and will continue to show, is probably not the wisest thing.
Yeah.
All right. Cons. Now I'm ready for this. I got some numbers for you, baby.
Dude, yeah. So the first one is when you buy a house, your payment is locked in. Right?
The principal and interest payment
are locked in. Yeah, insurance can go up, taxes can go up.
They go up minuscule
but that's
amounts.
not going to be a ton every year. Your principal and interest is locked in. That payment's going to stay the same over the course of that loan. So unless you refinance or do other things to it. So rents, that's not the case.
This is a con for renting. A con for renting is what?
Rents go up.
Yes, they do. Mm-hmm. And one of the problems we've had lately, I talk so much about inflation, has been that rental inflation is a huge component of the CPI, and that's really what's been showing it. They think it's going to come down, and it's a lagging indicator, but rents have gone up. I have some numbers. Now, I wish I had some more accurate numbers. This is from the Census Bureau, okay?
Yep.
And I go from 2016. I'm not going to give you individual numbers. I did some math because I'm good at that.
Yes.
Math. And from 2016 to 2021, the increase in the median rental payment is 16.2% over those 5 years. Ooh. Extrapolate that out to 20 years, not even 30 years.
So wait a minute. Give me some numbers then. 16%. 16%
is
if you have $1,000
rent.
Now what?
5 years later, it's $160
extra
per month.
Right.
If it's $2,000, it's $320. $2,000 seems to be more like this median rent. It ain't in Maryland. The numbers they're using here is they start in 2016 below $1,000.
Right.
And it just gets up to like $1,100 and change.
Right.
In 2021.
Yeah, there's not many places you can rent for.
Maybe you'd be better off starting in 2016 at 15 or 16 and then going up. It would probably be $1,900. Anyway, if you extrapolate that 16.2% increase over 5 years out to a 20-year period, that's an 82% increase. Let's say you even said to me, Michael, well, haven't we seen big increases? True. The increase in rent in 2021 was 6.62, much hotter than the other 4 years on increases. Okay.
Right. So some years you're going to have a higher number. Some years. So
let's extrapolate that down and say maybe it's only 15% over 5 years.
Sure.
That's a 75% increase over a 20 years.
75%.
All right. So that's how much you'll see rents going up.
So that's a portion. That's your housing budget portion of your income that you have to deal with. And the question is, are your wages going to rise up the same amount?
Exactly. Not only that, but rents are going to go up.
Yeah.
And you mentioned that mortgage payments don't go up, at least the principal and interest if you never refinance. I have another extreme example for you.
Okay.
I pulled up numbers from somebody I know near and dear who happened to buy a house in the year that you and I were born, 1965.
Yeah.
Okay. You actually sold that house.
I remember that house.
You sold the house just a couple years ago.
Yeah. It was a great house.
Yes, it was. But in 1965, when that house was purchased.
Yeah.
Now, they did use a 25 instead of a 30-year mortgage.
Okay.
So a 30-year mortgage means the payment would have been a little lower. The principal and interest portion of that mortgage payment was $74.80.
$74.80. That's, oh, my God.
The point I'm trying to drive home, folks, is if you continue to rent, if you were to continue renting and you bought a house today, let's say your mortgage payment's $2,500, but your rent payment would be $1,600, $1,800, somewhere in that range.
Yeah.
Okay? In 20 years, you're probably looking at $3,700 a month for that rent.
For the
payment.
rent, yeah.
Your mortgage payment is probably going to go up a little because of taxes, but you might be looking at 26 or 27.
Yeah.
And at the end of those 20 years, you're probably sitting on a significant amount of equity.
Yeah, absolutely.
So anyway,
Wow.
So there is definitely a con to renting, that rents go up.
Yes.
And your mortgage payment can be frozen in time once you buy.
Yeah.
All
All right. Well,
Another
next
con,
one,
which we talked about.
no real financial incentives to rent, right? Like we talked about the tax deductions. You can't get tax deductions. You don't have the equity.
The rising property value.
No appreciation.
No ability to avoid a nice capital gain and not pay any taxes on it if it's your primary residence.
Yep, absolutely.
Even though you're spending money as an important living expense, you feel like you might not be making progress. This one goes, the financial incentive goes to the one we talk about time and time again, where lifelong renters, it's either 40 or
40, about 40%. 40 times higher
the net worth
homeowners of a
have.
homeowner versus a renter.
Sometimes people get to retirement age, and if they've
been
rented their whole
lifelong
lives,
renters.
many people get to retirement age and they have either a pension. In the old days, you used to have a pension just would own your house. That's all you had. Now, since pensions have kind of gone away, you just
Right.
have either retirement savings in the equity in your house, and many people's greatest asset
Is the house.
by the time they get to retirement is the house. And then finally, a con, renting con, and we talked about this.
Yeah, no way to make it your own, really.
Can't
I mean, like you can paint a little bit, something like that, but
Right.
that's about it.
Right. If you want to put a new vanity in the bathroom or something like that, you can't. Well, I don't know. Maybe if you were my tenant and you wanted to upgrade the bathrooms at your expense, I'd say send me pictures. I might let you.
But then who are you benefiting?
You're benefiting.
Okay, you might get to enjoy the nice new, but you're financially benefiting the landlord.
Thank you.
Yeah.
If somebody wanted to update, any tenant of mine wants to update, put vinyl plank flooring in the bathrooms, put new vanities, toilets, and tile the shower,
Right?
go ahead, go for it.
Yeah. Sure.
Thank
Sure.
you. I might even give you a discount on next month's rent if you did that.
Yeah.
If you do good work.
Yep.
Right, but you're not going to be the one that reaps the benefits for it.
Yeah. Yeah.
So here we get to the next section. Is renting an apartment always cheaper? Well, if you look at monthly costs alone,
Yeah.
pretty much, yeah.
Yeah.
Right?
Sure.
But remember, we have to constantly talk about the other parts of it. Yes, it is cheaper in an expense way, but there's also they have the twofold on the other side of the financial picture: the tax benefits of owning a home,
Right.
both the potential deductibility of owning a home, interest and taxes, and also the advantage of not having to pay taxes on appreciation. But you're also not going to get the appreciation over time, like we've talked about.
Yeah.
So on a monthly basis, it does look like it's a lot more affordable.
But they say
The tipping point, I love
there's
this.
the tipping point. Right. If you rent for decades, you could end up paying more than if you'd bought a house in the first place because, as we mentioned before, unless you have an adjustable rate mortgage or you refinance and take a whole lot of money out, that payment stays relatively the same and the rents go up. So if you're going to stay put,
Right.
better to buy.
So it goes back down. Okay.
Yeah.
Right.
Yeah.
So that's what we're saying, folks. It's basically makes more sense to buy a house than it does to rent if you're going to stay put. Right now, this number could change. Brad likes since the interest rates are higher and the cost has gone up.
Yep.
If you buy a house and you're going to stay in it 5 to 7 years, it probably makes sense to buy right now. If you're going to move in 2 or 3 years, you might look at
you might
renting.
want to keep renting.
Now, if rates were to drop and appreciation starts going up again, as opposed to being kind of steady or just slightly going up,
Then that amount of time you have to stay put decreases. Yeah.
could change
Yeah.
again. So I
We
guess
just we want to help people make the right financial decision.
well, the
for
bottom
them.
line is it clearly for a great majority of people,
Yeah.
young people maybe, that's the question when you're a first-time home buyer. Are you at the point in your life where buying a home makes sense?
Right.
If you've rented for a couple years and you started your work career,
Yeah.
and you've had a couple jobs, but now you found a place that seems like it fits for you,
Yep.
that's probably when you should probably think, all right, now things are starting to tip, because I'm probably going to stay put. Probably tips towards buying a house versus renting a place. So when you get to that point in your life and you think it makes sense, what's the next question you have to ask, which is listed right here in the article?
Are you ready?
Are you ready?
Yeah.
So I think we should talk a little bit about that to wrap this up. What do you think?
Yeah, that'd be great. So we talked about the finances that are involved, right? So you got to make sure your money's in order, and that starts with a conversation with Michael.
Yeah. Well, at least, I mean, I always love, like, some people come to me when they're ready to buy. And then there's others who come to me when they want to buy. They have some savings, but maybe they need a little bit more
quite
time.
Ready yet? Yeah,
Correct.
sure. But it's great to talk to people at that point because we can help them put the plan together.
Right. Absolutely. If you want to be a homeowner, you do have to have a plan. Now, what often happens that can accelerate young people's ability to buy a home sooner rather than later.
Yeah.
It's when parents or relatives get involved.
Yeah.
Me as a father and you as a father probably understand the benefits of home ownership more than many.
Yeah, true.
So when it comes time to my kids buying a house, I probably would offer assistance in terms of a gift, some money to help for a down payment and or closing costs.
I'm not telling my kids what that might be at this point.
Well,
but
no. My grandfather made a deal with us.
It will be somewhere between $1 and more than $1.
I was going to say $1 million.
I'm not giving them $1 million.
No, but my grandfather, God rest his soul, promised my brothers and I, he whatever we saved for a house, dollar for dollar, he would match up to
That's
10
great.
grand.
Yeah. Nice.
So something similar like that is actually a great idea to tell your kids.
It's not a bad thing.
And if you're listening as a young person, go tell your parents you heard Michael Becker tell them that you got to have to match my savings, and then they can find me and yell at me.
Yeah, exactly.
But, no, it's a great idea. So
that's
something that can
definitely. If you see a
definitely...
long line of middle-aged people outside your door coming up soon, you know why.
So let's say... You're right. So they have to have a conversation with me, but there's several things that go into the buying a house and making sure you get the best deal when it comes to financing the home. All right, you have the savings, and you maybe even have the gift from family members. You have the employment and the income ready there.
Right.
But you haven't been paying attention to your credit score. That's something it makes sense to talk to me about, especially in this day and age.
Was that episode 3? I think it was episode 3. We talked about credit.
Right.
How about that? Pulling that out.
Well, it's become so much more important now because of the loan level price adjustments that are changed where now you need a 780 score to score the best rates unless you're below 100% of the area median income, which we can talk about at another time. There are programs that you don't need a strong credit score. But in the end, having a strong credit score will only help you. And the higher you should look to maximize it. And it takes some pretty simple planning in order to maximize it. You know, don't charge things and hold balances. That's bad because you're going to pay crazy interest rates. But also charge it up. Right. Don't miss payments. Pay everything on time.
Yeah.
Don't overextend yourself and get tons of credit.
Your utilization.
Yep. All those things. Well, we've talked about those.
Go back and listen to episode 3.
There you go.
Yeah.
All right. Beyond the financial
Yeah.
situation to keep in mind, you know, when you're going to, let's say you're financially ready, right, to buy a home. Hopefully, you've thought about the realities of home ownership. And I'm talking about maintenance and work. We've talked a little bit about the cons of owning a home.
Right.
But be mentally ready to do those things.
Yeah, absolutely.
Now, you have family members who've owned homes, they could be a great resource for information for you.
Absolutely.
As far as helping you out. Like when something comes up when you own a house, right?
Yeah. How much time did Dave spend over at his kid's house when
helping
they just
them getting it ready and set up?
Props to Dave.
Absolutely.
Good man.
Even
he's a good man.
Unless it's funny, I have a neighbor who's relatively young, bought a house, single family home across the street, and I believe his sister lives with him. She helps cover the mortgage. And he pays the landscaping service. I cut my own grass.
Yeah.
So those are the things I'm talking about. Are you ready? Now, I actually kind of like some of these things that you do outside. When I was younger and I had the kids around before they went away to college, when it came to springtime, how many bags of mulch did I get delivered to my house?
Right.
Now I pay somebody to spread that mulch because I don't have the cheap or free labor to carry the stuff around.
Well, I just told Ryan the other day, hey, looks like you're going to be power washing before you go away to school in the fall.
There you go. Love it.
Yeah.
How about gutters?
Yeah, clean them
cleaning,
out, right?
Sometimes I used to get up on the roof. I stopped doing that. It's been a couple years.
I don't do
put
roofs.
those things in to keep this stuff out.
We do.
But these are all things that go into mentally preparing yourself.
Yeah.
For buying a home.
Yeah.
So, anyway, I think that's a good way to wrap it up at this point.
It's great information. There's
So
there's
much
other
more.
factors that you absolutely. There's tons of things that go into these decisions. The point is, we wanted to give you an idea of a lot of the things that you could consider.
If you were to wrap it up,
how to be ready.
So somebody came to you and said, "Should I rent or buy?"
Right.
Let's wrap this up for listeners who are out there. So, should I rent or buy? First thing you ask about
Well, the first answer is it depends.
Correct.
Yeah.
And you would ask them, why do they want to buy a home?
Right.
And if they answer, so I'll give you an example why not to buy a home.
Yeah.
When the housing bubble was going crazy and people could get loans by fogging a mirror.
Yes.
I had someone who called me who was making $50,000 a year who wanted to buy a $500,000 house. I thought that was crazy. How are you going to afford the monthly payment? It's almost 100% of your gross monthly income.
Right.
I'll figure out a way, He goes, and I said to him, why would you want to buy a house? He says, because it's going to be worth $600,000 next year. Everybody was being a speculator.
Right.
You're buying a house to live in it. The pride of home ownership.
Yeah.
To start and raise a family. Those are all great ideas.
Yeah.
A side benefit of home ownership, it's not the main reason to buy it, but it definitely tilts the scales towards owning rather than renting, is the appreciation.
Yeah.
You want to buy a house because you're ready to settle down.
Yeah.
And you think you're ready for this commitment. That's a great, when you say that's a good answer for somebody
Absolutely. Absolutely.
say, so think about that wisely. Like, it definitely makes sense from a financial standpoint for most people. A lot of the financial advisors out there, there's people out there who say, well, it kind of died down. There are a lot of people who say, don't buy in the next year. We're going to see a collapse in prices. Well, that certainly hasn't
materialized.
And the alternative voice was Dave Ramsey, who a lot of people pay, who says, look, now buying because next year, guess what? That house is going to
be worth more.
So
more expensive.
You can't. It's hard to accelerate your timing in your life to buy that house.
Yeah.
Maybe with a little bit of financial support from family members, you can move it up a little bit. But when you're ready, I think you should charge forward and make it happen, because the longer you wait, the more expensive that house is going to be.
Yeah.
Down the road.
Yeah. And it's not all about cost. Lifestyle choices, the financial readiness that we talked about, your long-term financial goals, your sense of place, right? At the employment, if you're going to live there enough time, all those things go in. But one piece of advice, just speak to somebody who can help you sort through all that, just to determine what the right choice is for you.
And there's been plenty of people, we talked about first-time home buyers, and maybe we've tilted our conversation towards younger people. There's people who may have made mistakes in the past.
Yeah.
And because they've run up too much debt, they've been working really hard to fix their credit, pay off debt, to get
Could be a boomerang buyer, too.
Exactly.
Yeah.
Get themselves in a position to buy
That's not someone from Australia, by the way.
A boomerang buyer is somebody who went through a major derogatory event, a bankruptcy, foreclosure, short sale,
Yep.
and has that time, the wait period to buy a new house has passed, and hopefully they're ready. In the last decade, there were a lot of people who had approached that date, and they were legally, or not legally, but they were guideline eligible to buy a home.
Sure.
The wait periods, it's anywhere from 2 to 7 years you have to wait, depending on how bad
Depending
it
on
is
what the situation
and
was.
the type of loan that you're going to get.
Right.
That you have to wait. They were ready, but they were cautious because of the bad experience.
Yeah.
This conversation, look, if something bad had happened in your life and you're delayed owning a home, buying a home sooner rather than later will still benefit you as you enter retirement. If you become a first-time home buyer at 40, 45, it's still not a bad thing.
Yeah.
It's never too late to become a first-time home buyer. And if that's your goal, talk to a good agent, talk to a good lender, and they'll help you sort those things out.
Absolutely. Michael, thank you. It's fantastic information. All right, so we're going to take a quick break. When we come back, we're going into the Unreal and the Spotlight. So we'll be back in just a second.
Try it.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, sitting with my bud again.
Michael Becker of Sierra Pacific Mortgage.
Hey, Mike.
I got to get my timing in sync with you as far as your intro to me. I started speaking before you finished. I do apologize for that.
That's what they call pacing in the theater world, right?
Correct.
You're staying your line right before the end of the last person's line. Makes the pace go much quicker.
Sometimes in public speaking or in acting or anything like that, people do not like pauses or silence. Like when I was on the radio, dead air was a no-no.
Yeah. Well, but sometimes it makes sense. Dramatic pause.
Correct. If you pause, or if you're a comedian,
you
better have your timing down as far as pausing to let people laugh and the joke sink in. Because not always right in your face. You have to think about it for half a second.
But I think we've proven pretty clearly that we are not comedians. However,
it's true.
However,
we do know our stuff when it comes to mortgage and real estate.
Right. I'm not going to make my living in stand-up, but anyway. All right, Michael, rolling into the unreal.
Well, unreal is usually a bad thing, and this week it was actually a good thing, and it's something that I was delighted about.
Woohoo!
We had complained about some of these loan level price adjustments to the Federal Housing Financing Authority, or FHFA, who oversee Fannie and Freddie because they're in conservatorship.
Yep.
Loan level price adjustment for debt-to-income ratio was delayed to August 1st. They came out after many complaints by many people in the industry. One of those, the Mortgage Bankers Association, the FHFA issued the following statement. We're
sorry.
We're sorry. They are going to rescind the implementation of debt-to-income ratios. The reason it was an issue is because income for many people is pretty simple. If you're salaried, and your salary is a straight salary, no problem. But what if you have overtime? What if you have bonus? What if you have commission? What if you're self-employed?
Right.
Loan officers calculate it to their best of ability. But you could, even on a purchase, imagine you're on a purchase and you calculate someone's debt-to-income ratio based on the taxes you pulled up from the public record.
Yeah.
Homeowners association fee that you've gotten from a listing and an estimate of homeowners insurance.
Yeah.
HOA could be higher, your homeowner's insurance could be a little bit higher, and
Sure.
there could be something missing from the taxes from that listing. Maybe they didn't include the sewer service, water distribution.
Right.
All three of those things could have come in a little bit higher, push you over a 43% debt-to-income ratio, and all of a sudden, guess what?
Bam.
Your rate's higher, Mr. Borrower. We talked about it when we did the show, when we complained about these initial loan level price adjustments. We did a little give and take. Mr. Barr, I'm sorry. Your interest rate's an eighth higher because your debt-to-income ratio is a little bit higher.
Oh, well, that's terrible. Maybe I'll put more money down.
Well, if you do that, your rate's going to even go higher because they charge you more as your down payment goes from 5 to 10%.
What? That's
None of that
ludicrous. Yeah.
Anyway, this was a win for the industry.
It was.
But I'm going to read a quote from the Mortgage Bankers Association and then comment on it. Mortgage Bankers Association urges the FHFA to continue its engagement to improve clarity and transparency regarding the GSEs, government-sponsored entities, that's Fannie Mae and Freddie Mac,
right?
Regarding the GSE's pricing framework. We will continue our work with the agency, the GSE's lawmakers, and the body and administration. Oh my gosh, I don't have the rest of the quote. To fix these things.
Right.
This is what they need to address. It makes no sense, folks, that a 15% down payment has a higher rate than a 10 or a 5 or a 3% down payment.
Right.
For almost all the buckets. There are a few that do. The lower buckets, I mean people with lower credit scores. The problem is people with 660, 680 scores are probably going to go with
Fannie Freddie.
They're going to go with an FHA loan.
Yeah.
So some of their pricing adjustments didn't make sense. This was a win. Maybe I'm not counting on seeing any further changes, but it sure would be nice.
Yeah.
If they did. Or if
it
they
would be
thought
great.
About it.
Well, semi-victory. So let's take them where we can get them. Anyway, all right. So Michael, rolling into the spotlight. Last week we talked about steamed crabs. That got me thinking about kind of the sister food. Yeah, because remember we talked about cantlers.
Yes. I know many people who love steamed crabs, but do not like the picking of steamed crabs. So what do they do?
The alternative is crab cakes.
Yes, sir.
Yeah. So love crab cakes. So some of the best that I've ever had, and there's plenty. We could get into a real debate. Everybody has their own favorite place for crab cakes. But
I would say the restaurants are going to name is probably in the top 5 of everybody's list.
Yeah. Including somebody pretty famous. Yeah, talking about Pappas. So they have.
Which Pappas are you speaking
Well,
about?
they got 2 locations, right? They have the original,
Yeah.
the OG Pappas
Right.
on
Yeah.
Taylor Avenue
Correct.
in Parkville, and then they've got the newer version up on Cranbrook Road in Cockeysville. So the key for them, this is what makes their crab cakes so good. Tons of back fin, very little filler.
Jumbo lump.
Yeah.
Back fin.
It's just enough filler to hold it together.
That's the key.
Yeah, absolutely. And now, here's the thing. I
You
got
ever had
a
a crab
challenge.
cake?
I have
Go
a
ahead.
what? Go ahead.
I was going to say, you ever had a crab cake outside of Maryland?
Well, the things that they call Maryland crab cakes outside of Maryland,
It's ridiculous.
they don't know what they're doing.
Daniel Boulode, he's a great restaurateur, has great restaurants in New York and all over the world. I was in Palm Beach and went to his restaurant
Yeah.
at a hotel. And he called it Maryland crab cakes, and there were mangoes and peppers. I'm like, dude, that's not a
What the heck?
That's not a mango.
That's
crab.
not a Maryland,
Maryland
crab
crab cake. I call
No.
it it's a mango crab cake.
Right.
What the
don't,
heck is that?
Yeah, don't
Don't
bastardize
put all
my
that
food.
stuff in it. Keep it simple, stupid.
Yeah, absolutely. All right. Well, so
Pappas.
here's
which
the
one do you
challenge.
give me? Okay.
Here's the challenge. I'm gonna put a challenge out to all the Maryland restaurants that are good crab cake restaurants. Please come up with a gluten-free filler option, because
Oh, they don't really.
I haven't seen very many, and I'm dying
I'll
to
make
get
you a
some good.
gluten-free crab cake.
I would love you for that.
I have a sister-in-law who's gluten-free, and I make a gluten-free crab dip for her every
Ooh.
Christmas.
Well, sign me up.
You have to get this is the trick. There's panko breadcrumbs that
Right.
you can get them gluten-free,
Yeah.
or breadcrumbs that are gluten-free. Just
That
use
works.
because you just need those kind of. A lot of people use Ritz crackers or some kind of crackers or breadcrumbs.
Yeah.
And it's just a binder. It's just enough to hold
Yeah.
the crab cake together.
Yeah. All right. Anyway, so 2 locations, the OG in Parkville and then the newer one in Cockeysville. The other thing that I really love there is appetizer-wise, they're these stuffed mushroom caps.
Yeah, the stuff with crab meat.
Yeah.
Of course.
Yeah. So out of this world. So good. They also have chickens, burgers, steaks, pasta, whatever, if
Yeah,
you
but
want
you're
that
not-
kind of
why
garbage.
would you go
But
there?
if you're going to Pappas, don't go to Pappas for
It's
a burger.
not garbage, but you're going there for crab cake.
Right. But
In
anyway.
fact, I go. They're huge. You know, they're like 8-ounce crab cakes. They're
Yeah.
monstrous, right?
Yeah.
And you can order 2.
Yes, you can.
The reason you order 2 is
So you
why?
take one home.
For yourself later, or if
to a
some
significant other.
correct.
Yeah,
They
yeah.
will love you for that.
They will. The other person who loves crab cakes, Oprah. Pappas has been on her.
Oh, has
her
it really?
Oprah's favorites for years. I think she's raved
Oprah
about.
Winfrey's in the top 2 person I ever waited on is for a percentage tip. They
Really?
gave me. Correct.
How about
I
that?
Waited on her when I worked at the Polo Grill for a little bit
Wow.
back in the day.
And she took care of you.
She did. She was extremely nice.
She's good people.
She was.
How about that?
She did shows on tipping.
Really?
Telling
How about
people how
that?
to tip. She really cared about service industry people.
I like that. Well, definitely. All right. Well, anyway, they're on Instagram at Pappas Parkville, and it's Pappas,
Correct.
Pappas Parkville, or at Pappas Cockeysville, or you can call them. Taylor Avenue is 410-661-4357, and Cranbrook Road is 410-666-0030. But if you haven't been, go try the crab cake.
I don't even think you need to put. If you were to Google Pappas, you didn't even have to put in crab cake. You put in Pappas,
You'll find it. Yeah, they're just outstanding.
I agree.
Absolutely. All right. Well, Michael, that's it. Episode 18. Episode 18.
We're now legal.
We can vote.
We can vote. And own a gun.
We can't drink yet, but we can vote. But we have a surprise coming up for when we can drink. So that'll be cool.
When the episode gets to 21.
Yes.
Right.
Yes.
All right, that's a little teaser for
It's
the
a little
future.
teaser. Yes, we're not telling you what it is
Next
yet. But
time, what are we talking about?
we're talking about winning the house. How to make your offer stand out from
Makes
the crowd.
perfect sense. We've convinced people that it's time to buy a house.
Yeah.
It's not the easiest market in the world to get a house, so you need to know how to submit an offer to win and beat those other.
We've been, yeah.
You know what's out.
Right. And it's war. No, but there are some tips that
sir.
and strategies that can make a huge difference. We've been very successful recently. I think we mentioned,
I'm impressed.
I'm telling you, I think I mentioned about the buyer that we had last year who God love him, put in 15 offers before their offer was accepted. Ooh. That's an anomaly, but
no, it happened. I had people like that.
But I have had the last 5 or 6 deals that I've gotten under contract from a buyer side. It's been the buyer's first offer, and they don't know what they're missing out on by getting their offer accepted the first time. But boy, it sure is nice. So anyway, so we've got some tips, the ways that we've been successful to help our clients, and we're going to share some of those with you in the next episode. So if you want to listen to us, check us out on the web, BeRealPod.com. We're also on any of the major podcast platforms. We just created a new YouTube channel. Yeah, so we're on YouTube. Just search for @BeRealMDPod. When you get on there, subscribe, like, and comment, folks. We certainly need your support and want to get this message out to people who may need it. So we'll also ask if you know of anybody who might benefit from some of the information we share. Please send them our way. Have them listen to the podcast, and we greatly appreciate that.
Yes, we would.
Absolutely. All right, so Michael.
Yes, sir.
Somebody reaches out to you to get information on mortgage stuff. How do they do that?
They need to call me on my cell phone, 443-310-0012. You can also text that number. Again, it's 443-310-0012. My email address, which I can be reached at, is michael.becker@spmc.com.
Excellent. And that will be linked up in the comments. And me, if you need to get in touch with me to talk about your real estate plans, my cell, 410-375-7550. Again, 410-375-7550. And my email is brad@homesbyvesta.com. All right. So, folks, thanks for listening.
Thank you.
Another great episode, Michael. Thank you. And we'll talk to you in the next episode of Be Real,
the Maryland Real Estate Podcast.
Take care, folks.
Try it.